Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth, and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Monday afternoon, we have Max Cabasso, managing director on Nasdaq's market intelligence desk, for an update on technical levels to watch in the Nasdaq 100. And Max, it's nice to see that we're coming off the lower levels in the session following that swoop that we saw on Friday. What are some of the key levels that you're looking at right now in the Nasdaq 100?
Hey, Jill. So obviously Friday was a tough one, and kind of followed through this morning, and then we're off it, like you said. I think the first spot we're looking here is both the 50 and 100-day moving averages. 50 days, just below 12.5, 12,500. The 100 is 12,639. So we're right at those levels. If those don't hold, though, I think we're going to go back to that 50% retracement from the lows, the March 2020 COVID lows, which is 11,768. We bottomed just below that, or just below that 11,000 level back in June. So I think that 50% retracement is going to be that first stop before we start having the conversation of, have we already seen the lows of this bear market, or are we going to retest those lows from back in June? But like I said, the 50 and 100 day are going to be the first stop, and then that 50% retracement at 11,768 is kind of that next spot that we're going to keep an eye on.
And this chart you have here on rates is interesting. It looks out to 2024, assuming that those potential rates are taken, and what the implied and real rates will be. What is this that we're looking at here?
So this is the implied rate hikes or cuts. So as you can see, in September, the September meeting that's upcoming next month, markets are pricing in almost 3 hikes, so 75 basis points. Right now it's a little bit over 2. So right now the implied hike is 69 basis points essentially. So we're getting back to that 75 basis point hike being priced into the markets. That's kind of where expectations are. We had come off before Jackson Hole, when Fed Chair Powell came out to speak and kind of put that back on the table that they're going to get inflation under control. We'd come back in to kind of 50 basis points, and maybe another 50, and then kind of tailing off. Whereas now we're looking at September, we're essentially pricing in 75 basis points, and then another 50 in November, and then essentially another 25 in December, where we had initially seen it was kind of 50, 50, 25, or 50, 25, nothing, and then higher cuts starting in early 23. Now we're starting to see that getting backed off, that the Fed pivot that had been kind of the talk of the town as markets started to rally, that's come back off. So now we're seeing markets are now expecting again 75, essentially. We're not there yet, but essentially looking at 75, 50, and then 25. So there doesn't look like there's going to be a pause, or at least markets are not expecting a pause in the Fed's rate hikes, going to the end of the year, which is kind of what had been expected before, the Jackson Hole meeting last week.
Right. And Max, to wrap up here, let's talk about growth versus value, because we saw this during the pandemic. We saw this during the move off the June lows. What led the way up led the way down, and vice versa.
Yeah. So as you see, the move in 2020 was as quick as it's ever happened before. This is actually it was the most incredible move. It was 4.5% per month was the outperformance of Russell growth versus the value stock. So we had that kind of money, cheap rates, nothing was slowing down growth, and we've collapsed back below. We're kind of back to levels we saw in the kind of mid early 2000s. So there's been a lot of talk about, will tech, which is kind of taking us down, will tech lead us out of this bear market, or is it going to be the value stocks with rates continuing to climb? We saw that kind of attempt in this recent rally where growth was going to lead us back out. But it looks like this 55 is going to be that kind of level to watch. Is growth actually going to lead us out? I tend to doubt it at this point, but it's definitely one to watch. You said it led us on the way up and also on the way down. So there's been a lot of talk of growth is going to lead us back out of it. It's really going to be tech leading us out. I could be surprised, but that's kind of the new narrative. What's being discussed now? Is it going to be growth, or is it going to be value? Kind of where to park your money, over the next 6, 12, 18 months.
All right, Max, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.